and welcome to the Consumer Credit Matters podcast. I'm your host, William Black, and welcome to episode 7, featuring my discussion with Steve Linehan. Steve is a veteran capital markets and consumer credit expert. He was kind enough to sit down with me and discuss his multi-decade career trajectory with me, with all of us. I have to say he was very candid and entertaining, and also, quite frankly, instructive. A lot of wisdom shared throughout our conversation today. And he starts off speaking about some of his formative years as a regulator with the FDIC, and then moved on to become the treasurer of Capital One during its go-go years and ascendancy to become one of the largest credit card banks in the country, if not the world, and shares with us along the way many anecdotes, many war stories, warts and all, throughout those years. And then he goes on to tell us how he was pulled out of retirement to do none other than start up a brand new credit card company called FairSquare, which ended up being another notch of success for Steve, as that company did quite well before it was sold off then to Ally Bank. Again, I found the conversation to be very engaging, entertaining, and educational, and I hope you do too. And I hope you enjoy the conversation as much as I did. And thank you for joining. Steve Linehan, welcome to Consumer Credit Matters podcast. How are you?
I'm doing great, Will. Thanks for having me.
Well, my pleasure. You and I were talking ahead of time on this, and it's pretty clear to me that this is going to be a long one. You and I met, I don't know, gosh, it was probably close to 20 years ago, maybe longer, when you and I intersected. I being at Moody's, you being at Capital One at the time, sure. And that's where you and I first crossed paths, and it was to discuss some angle on your credit card securitization program at the time. I know probably in the scheme of things, a very narrow focus for you, but it was kind of my whole world back in those days. And we just stayed in contact all these years, and you've had just such an interesting career, not just at Cap One, which was interesting enough. I mean, that is, now I guess with the acquisition of Discover, will be the largest credit card issuer in the country, if that acquisition is approved, and really just so many unique milestones in that sector that I'm sure you're going to get into. Right. But you had a start before that with the FDIC and some other financial companies. And then I think, to put a cherry on top of your career, you moved out of, I think, between retirement number one and whatever you're calling where you are now, you just threw in a startup into your resume there, and started up a credit card company that I think is just a fascinating story in and of itself. So that's why I say, when I reflect on where I think our conversation is going to go today, it's going to be a long one, but I think a very, very interesting one. So, Steve, welcome again. And I'm sure I didn't do your background justice, but why don't you just give a brief introduction before we dive right into, your career path and your history and all that you've brought to the industry.
Yeah, sure. But first, I'd like to just thank you, Will, for inviting me to do this. I was really humbled when you asked, about a month or so ago. As you said, we've known each other for probably more than 20 years. And, I don't know if there are issuers and rating agency people who tune into this, but, relationships between issuers and rating agencies often have kind of a little bit of an adversarial kind of tone to them. Issuers want higher ratings and lower credit enhancement, and rating agency folks want to make sure that they stay true to their methodologies, and often we butt heads. But, in your case, I always look forward to our interactions. I always thought you to be, incredibly smart, thoughtful, brought a lot of wisdom to the conversations, and you just had a genuine curiosity to learn. And
Well, thank
so
you.
I always really, really look forward to our interactions. And so when you asked me to do this, I was honored. So
Appreciate
really,
that.
really happy to be here and really happy to reconnect with you.
Likewise.
So, at a high level, I've been in financial services for, the better part of 40 years. I started off in smaller institutions, went to a money center, spent 8 years at the FDIC, which was an extraordinary experience, and then Capital One, where I spent most of my 18 years there as the corporate treasurer. As you mentioned, I kind of retired from Capital One, thought I would just spend some time here at my place on the Chesapeake Bay on my boats and
Nice.
do a little consulting on the side. And then I got kind of pulled back in to the credit card industry to join a startup as a CFO. And that was, FairSquare Financial, which we started in 2016 and sold to Ally Financial in 2021. So, I'm a child of the 60s, and I like to say that the soundtrack of my life has been provided by the Grateful Dead. So I would say, in summary,
Which song?
in summary, my career can be described as a long, strange trip.
Wow. In one meaning of the word, I assume. We'll take a very narrow Wall Street interpretation.
Yeah.
Well, that's fantastic. Yeah. Well, actually, again, there's so much to talk about. I think it's going to probably,
Sure.
serve the storyline, if you will, best if we start from the beginning. I think of your, this is probably too simplistic, but I think of your career path as kind of 3 acts, or you could kind of divide it into 3 distinct chapters. You could probably divide it into several more than that. But I think of kind of your pre-Cap One formative years, which are really, really interesting, particularly your stay with the FDIC, because that's the kind of experience that's A, difficult to get, B, you were there during a very tumultuous time for the FDIC then, and you worked in a couple of different divisions in that for the FDIC that gave you, I think, a very kind of, I'll call it a 360 kind of view of what they do at a very core level. And then lastly, that just served you so well in every other job that you had as a foundational understanding of how these finance companies, these companies interact in the banking world, need to interact with the regulators. So I don't know, maybe we can start there.
Yeah. So, when I think back, just going all the way back to the beginning, which is kind of, I think, important to the story because, it was really on my first job out of college. Well, my first, what I call my first indoor job, my first job indoors, because I graduated from Notre Dame in 1982 when the prime rate was 21% and we were in deep recession, so I couldn't find a real job. Mm-hmm. And so I dug trenches in the Arizona desert for the first kind of cable TV network.
Wow.
In 110-degree heat.
Wow.
Yeah. So that was like, that's what my Notre Dame degree got me. But then I was able to get a job in 1983 for $2 billion savings and loan headquartered in Las Vegas, publicly traded company, largest S&L in Nevada. And it was an enormous opportunity in terms of kind of figuring out what I wanted to do, because I got to work very closely with the treasurer and the CFO of the company. And my job there, and got a job in the accounting department. And my job was to put together the financial statements, the management reports, and the call reports for the company. And back then, there was no such thing as personal computers or no computers on desks back then. So I did all of that on a piece of paper, a spreadsheet, a 10-key calculator, and a pencil and an eraser. And I would take, the big reports that came out of the mainframes with the general ledger accounts, and I would take those figures and add and subtract, multiply, do whatever necessary to fill out those financial reports.
So what year is this now, Steve?
It was 1983.
So, people forget that not everybody had a PC on their desktop back then, or that actually, I don't even think Excel was. No. If Excel was around, it was just born, and it wasn't on people's desks like it is now. I think it was Lotus 1-2-3, and there was something
Lotus 1-2-3.
I think it was VisiCalc before that. But this was pencil, eraser, everything but an abacus. I think we had progressed from the abacus, maybe.
Yeah, exactly. Just turning off my notifications. But that's where you learn, and having to do it by hand was kind of how you learned what financial statements were in a financial institution and how balance sheets and income statements interacted with one another. I got a really great understanding of a financial institution from that work. And there are two kind of other things that were kind of key. One, working so closely with, the CFO and the treasurer, I decided right then and there that, someday I want to achieve a position kind of as part of a senior leadership team that gets to create the strategy for our company. I want to be one of those. Mm-hmm. So I decided early on that that's what I was going to work back from, and every move I would make in my career would be in service of that. That is to say, I'm going to try and make a move that would give me additional competencies and knowledge that would help me accomplish, those roles. And the second thing was I just fell in love with banking. I just loved it. And so, having decided that,
what was it about it that you loved? I by the way, I just want to pause on both of those thoughts for a moment, because this is the part. There's a lot of young people who do listen to this podcast and are probably very interested in how one gets started. And you know that times are strange right now, particularly for people just starting out in their career, because of the. I think we could point to the work from home situation as creating a different dynamic than the one you and I grew up with. And it might be harder to make the connections and therefore gain the knowledge and experience that you need or as quickly as maybe you and I were able to do, because you kind of had boots on the ground, and there was more an opportunity for the kind of water cooler conversations that went on then that probably aren't happening as much today because of the virtual workplace. So what was it about banking that you loved, that you identified that you loved, and how did that come about? What was that process? I think also it's fair to point out that it's relatively unique for someone at that stage in their career to have, the wherewithal to reflect on what it is that you're going to, your big picture vision. You were already at that age mapping out strategically what you wanted to do and how you were going to get there. The tactics you were going to kind of fill in, but the strategy and the vision was there at an early age. How did you get there? I mean, that would be, if you could crystallize that, that would be, I think, very.
Well, I was just blessed and fortunate to be able to work closely with senior people.
Yeah.
And, I guess it was, one would call a relatively smaller company where I could do that. So getting exposed to all those things, just fed that kind of learning and helped me form what it was that I wanted to do. So, to me, banking is incredibly dynamic. It serves an incredibly important purpose in our economy. There's so many aspects to it that I just felt this is a really cool place to be. And for younger people, and I often have counseled people who come to me for career advice, And, I often tell them, even though you're young, it's not too early to figure this out.
Right.
And to some degree, it depends on what burns inside someone and what they really want to work back from. There are some people who do great, just kind of doing what they do. They make a decent living and all of that. But I was really yearning for something that would be incredibly intellectually challenging and have big impact. And to me, as I described what, those senior people do in running an organization, I didn't have a CFO or treasurer title. That's not exactly what I was working back from. I just wanted to be somewhere where I can make a big impact on an organization. I thought that was really cool.
Right.
And so I figured that out early on. So what I would advise people is, go to the office and have a head on a swivel and learn as much as you possibly can so you can form that view. And you can't wait too long because as I'll talk about my experience, it is a gradual building blocks of competencies and qualities of leaders that you have to develop over time. I've written papers on leadership, and fundamental aspect to that is there's no such thing as born leaders. Anyone can make themselves into a good leader. It takes study and practice, but anybody can accomplish that if you set out to do it. But it takes time.
Yep.
It takes experiences. And so it's never too early to start on that path because, you have to get all of that exposure and experiences in all sorts of situations.
Got it. So you were that. Thank you. That's very helpful. And so back to, I guess, your first indoor job.
Yeah.
And you had great exposure. You derived at your kind of strategic vision for yourself. And then what? So next move.
Figuring that I wanted to be in banking at the time, this is mid '80s. I just thought, well, the center of the banking universe is in New York City.
Okay.
And if I was going to be, great at being a banker, I got to go be with the best bankers. And I just, whether I was right or wrong, the best bankers in my view were in New York City.
Yep.
So I packed up my bags and I went to New York City and I took a job at Manufacturers Hanover. You and I discussed this before we got on. Called Linehan at the time, was one of the largest money center banks in the world. And I said, well, this would be a great place to learn how to be a better banker. And I was disappointed because, it probably had 100,000 employees at that time. Huge. And I was just a small cog in a huge machine. I was working on one slide every month for the big 200-page management report. And I just quickly decided I'm not getting what I really need to get in order to work back from that, a career objective. I did learn how to write. You don't really learn how to write in college. And so I learned how to write from kind of an analyst perspective, take that data, write about it in a way that a senior executive can take, get the key takeaways for whatever data is on that page. So I did get that, but, I needed to get out. And I saw an ad in the Wall Street Journal. Back then, they were right. That's basically the only way you figure out where the jobs are. And
there was no LinkedIn back then. It was the want ads for sure.
An ad in the Wall Street Journal it was like an assistant vice president in charge of building and running the first interest rate risk function at a savings bank. And it was located in Westchester County, just north of the city. And I said, even though I don't know really anything about interest rate risk in the mid '80s was just an emerging thing. With the deregulation of interest rates in the early '80s, banks now had to worry about matching assets and liability durations. Before that, bankers showed up at 9:00. They worked 8 hours. They went and played golf. I mean, it was pretty easy,
right?
Because interest rates were basically fixed, and so it was an emerging kind of risk area in banking. Everybody had to have one all of a sudden. So I went up there, and I built the competency that was important of building and leading teams and building and leading processes. And it was a great learning experience. And the other thing that it brought me, again, was the ability to work with senior executives in a company. To run asset liability management functions, you have to know the cash flows of every cash flow stream in the institution, assets and liabilities. And how do you do that? Well, you go talk to the senior executives leading the lending business. You go talk to the deposit guys who are running deposits and understand where they expect to take the business. And you got to take all that data, run it through a model, and create reports. And so then again, I was then learning even more and more about how a financial institution worked. And
how it funds itself, and which it's right. I mean, this is not how it funds on a an inter unit basis, and how it funds itself, wholesale, and so on and so forth. And you were there at a time of where there was some innovation going on as well, which I think you're going to get into. But I mean, this is, again, there's the kind of what came from you, which is the strategy and the vision and the kind of self-motivation. And then you also happen to be then you put yourself in the right I mean, arguably, I don't want to be too New York centric here, but I mean, I think it's pretty safe bet that New York was, if not the center, awfully close to the center, right, of where you ought to be given your ambition.
Exactly.
And then it was as you said, it was a very dynamic time for banking.
Yes.
A lot of changes going on, and asset liability management became a core competency skill, and remains today to be a core competency skill.
Yeah.
And not that it wasn't before, but it was much simpler before, as you said.
Again, it was with the deregulation of interest rates where it really became a critical thing. A little side war story. I remember it was October 1987, and I was sitting in front of the teller ring. We didn't have Bloomberg back then. Bloomberg was the only starting to kind of shop his wares out of a suitcase. He'd go to a financial institution and say, hey, this is really a good, cool thing if you have a mortgage-backed security portfolio. But at the time, we were all using Telerate. And I'm sitting in the office watching my Telerate. My boss, treasurer, and the CFO were downtown. They were at a board meeting. And the stock market crashed. Right? It was Black
87.
Monday.
Yeah.
87. And what was kind of relevant for us was the fact that interest rates were plummeting.
Mm-hmm.
And I was looking at the swaps, the swaps page, and it's like, here's an opportunity to put in place a fixed rate swap at like historical lows. The pay fixed side, which we needed to fit. We needed because all our liabilities were kind of short term, and we were a mortgage lender. And wow, this could be an opportunity. And I'm frantically trying to get him on the phone. Can I do this trade?
Right.
I finally got it. We booked a ton of fixed rate swaps, which really helped our interest rate risk position. But that was like the first trade I was ever able to do, which was pretty cool. Yeah,
that is cool. Yeah, that one paid off for sure.
Yeah, it did. It did. So up to then, I was making moves, working back from that career objective. I only made one move in my life, and it was in kind of like 88 for financial reasons. I'd been married a couple of years, wanted to start a family, wanted a house. New York City was way too expensive. So I essentially took a job in Baltimore at another S&L. Cheaper place to live. The twist in that one was the S&L had $150 million of negative net worth. But it was kind of, industry kind of chatter was that it would be one of the S&Ls rescued by the FSLIC. and that it would be, if a new investor would come in, it would be fine. Well, that didn't happen.
Right.
And the S&L failed, the RTC rolled in, and I worked there trying to help those guys out for a while. But then I parlayed that into a job at the FDIC. And I worked on some really cool things in the beginning, actually getting on the other side of those assistance agreements, trying to negotiate the cost down lower. And I got to go up against some of the titans of industry because, big names were coming in, buying these S&Ls because you didn't have to be a bank holding company. Being an S&L, you were exempt from the Bank Holding Company Act. So you had all these guys rolling in, getting all sorts of assistance from the government. My first job was figuring out how to reduce the cost. So a lot of really cool assignments there. In fact, part of that, I often say I was Lou Ranieri's boss for a while. So for those who are too young, Lou Ranieri was considered the god.
Yes, I was just going to say. I don't think he invented securitization, but he certainly is credited for popularizing it. I mean, he was in the
Liar's Poker.
Liar's Poker. Okay, yeah, I was trying to remember the Michael Lewis book that he was in. Okay,
Liar's Poker, and we had taken possession at the FDIC. We had taken possession of the largest mortgage-backed security portfolio in the world at American Savings Bank, which had tried to, arbitrage its way by putting on a bunch of fixed rates, funding short, and trying to fund their way out of a problem, which didn't work. And so we hired Lou Ranieri to liquidate that portfolio. So Lou and I would have weekly calls and say, "Hey, Lou, how you doing on this thing?" So,
and this is a big deal. So this is like after he kind of introduced mortgage-backed securities, and that. So at least mortgage-backed securities, that part of securitization had already been up and running, but the rest of it, not so much, right?
Yeah. So exactly. So it was the '80s. It's kind of the birth and emergence of Fannie Mae and Freddie Mac that was providing all that liquidity to the mortgage market. Securitization was obviously a huge part of that. And, Lou was at, I think it was Solomon Brothers at the time. And then I think he might have gone off, started to do his own thing at that point, and we hired him as a consultant.
Gotcha.
So there are just so many unique experiences like that. When you're in a crisis like that, it's all sorts of crazy situations come up. And so, but did that for a while. Then I rolled over to the Division of Resolutions, which was the FDIC's version of kind of the RTC. RTC focused on S&Ls. Division of Resolutions focused on banks. And, the banks started failing. This is kind of 91, 92.
Yep.
And the FDIC essentially hired in the investment bankers that were being used as consultants. It was going to be more efficient. And these bankers, just felt like it would be a great public service to come in, be more efficient in getting these things done. And I got to go work for that team and work with, these Wall Street guys who are really, really smart.
The job here though was focusing on banks that failed, past tense, and liquidating them, basically maximizing the value for those banks.
Actually trying to sell them before they were.
Oh, before. Okay.
Yeah.
Okay.
So I'm glad you asked that question, Will, because one of the things we were proud of in resolutions was creating the loss share structure, where we essentially would go in 80-20 on the losses of a bank, the losses we calculated. And we would provide 100% of the losses, 80-20 up to a dollar amount. And then we would provide 100% coverage over that dollar amount. Now, of course, that dollar amount we calculated, we thought was a true loss. Providing 100% coverage over that amount, we didn't think it would go over that amount, but it gave potential acquirers a lot of confidence.
Right.
They had skin in the game. but they also had a lot of confidence. So it drove up the premiums they would pay to buy these, essentially they were after.
You basically chopped off the tail of that risk for them,
Yes.
right? So they didn't have to worry about that. But, you also kept in what you might think of as kind of rational or reasonable economics. So,
yes.
And you have that public-private kind of balance to strike as well. So that makes a lot of sense.
Yeah. So they still use that structure to this day.
It's still 80-20?
I don't know if it's 80-20. It may vary depending on the bank, but the basic structure is still used effectively to this day. And I got to lead a couple of large bank resolutions on my own, which was really cool. And but then 1994, banks stopped failing, which I kind of then looked around and was like, what am I going to do now? One thing I did is I went back to business school part-time. Mm-hmm. And then, I got selected to be one of, let's call it 4 or 5 folks to go start a new division at the FDIC called the Division of Insurance. And the sponsorship of that division was by the new chairman, Ricky Helfer, who was the first woman chairman of the FDIC, an amazing, amazing person who I got to work closely with as well. But that new division really had 2 objectives. One is to create a new risk-based approach to pricing deposit insurance. Before then, it was kind of one size fits all. Mm-hmm, mm-hmm. So it kind of makes sense. You're an insurance company. You need to kind of relatively rank risk of all the banks and figure out what deposit premium to charge those banks based upon risk.
Right.
The second major objective was to kind of bridge the gap between the pure research function at the FDIC and the examiner in the field working in the banks. And bridge the gap meant kind of coming up with new analytical products that would help the examiner in the field understand risk, and also, provide those products to the industry to help people think about risk. Think of this part of the division's mission as a research function at an investment bank, right?
Right.
We're looking at the national economy, regional economies, capital markets, all of those kinds of things, trying to create analytical products that would take all of that information and make it have meaning for the examiner in the field.
Is this boiled down? I might be mixing up my regulatory jargon here, but did this boil down into like the CAMEL, the so-called CAMEL acronym or score, or is this different? Okay.
CAMEL ratings are just the ratings that examiners use to rate the capital
adequacy,
asset quality, liquidity, management, etc.
But it is a proxy for relative risk, is it not?
Yes. So we use the CAMEL ratings in kind of that insurance premium, risk-based insurance premium structure. Absolutely.
Okay. Gotcha.
So, I learned more about agricultural banks than I ever cared to know in that role. But it was really cool. Again, when I think about my career objective, another opportunity to build a team, figure out what products were we going to produce, and so again, another opportunity to build those competencies, and of course, learning a lot along the way. And this is now in the mid-90s. So what was going on in the mid-90s that kind of emerged for us on the risk side was the birth and emergence of the monoline credit card banks, as well as the democratization of credit, which is a really fancy term for subprime lending.
Right.
And so that was like high on our radar screen. And so I really learned a ton about what was going on in credit cards and in subprime. And in fact, a couple of things I did there, the FDIC DOI, was I wrote the first financial institution letter, which is kind of an informal guidance to the industry and to examiners about subprime lending. And another thing I did was I wrote congressional testimony for the chairman that she took to Capitol Hill and delivered on credit cards and subprime. So,
I want to just mention something, an anecdote from my memory in the early 90s, just to paint a stark a reminder of something you just said, and that is that you were introducing that was the beginning of the democratization of credit. Boy, in the early 90s, if my memory serves me correctly, that was a tough time to get a credit card.
Yeah.
Certainly when you were young. I remember, I was just out of college about then, and I was applying for credit. I didn't have a credit card, like most college students or even high school graduates are getting credit cards. Maybe even before then, I don't know. But they were not easy to get.
No.
And I got declined many times before I was finally accepted. By the way, I still remember the first credit card I got was a Discover card back then. So you kind of have that memory of, oh, wow, I got somebody believes in me, or somebody will trust me to lend me money. Right. And it was really hard. And back in those days, interest on credit cards was still tax deductible.
Tax deductible, right?
Right. Very different incentives, right, around the use of consumer credit back in those days too. Obviously, both of those are kind of now vestiges of the past.
Yeah, it's funny that you mentioned Discover being your first card. My first card was a Sears card.
Oh yeah, same company.
Remember, at some point, Sears and Discover became one.
Yep.
Mine was a Sears card. As you described, we like to think at Capital One, we were one of the pioneers in using information to better make risk assessments on borrowers and then appropriately price for that risk. And so, we felt that really great customers were paying way too much for credit cards, and that there was a whole huge population of people who couldn't get access. And we could give them access by giving them the appropriate interest rate on the card, as well as the appropriate credit line. And so, sloping for risk was really what it was all about, using, massive amounts of data that were available at the time. And of course, computing power was just growing exponentially at the time. And so, that was Rich Fairbank and Nigel Marsh's thesis, that they shopped to the industry, and only one bank took them up on it, and that was a regional bank called Signet.
So before you get there, I want to understand you were still at the FDIC.
Yeah.
You said there was this kind of, again, another shift in the marketplace that you happen to be at. Around democratization of credit and monoline credit card companies.
Right.
And you had the regulatory perspective into that shift in the market dynamic. I'm guessing here that, there was, concern that the FDIC wanted to make sure that they had their arms around this shift. Did you have an active role in, developing the...
So one of the things that, the teams, on kind of both sides of the Division of Insurance, as well as in partnership with the FDIC Research Division, was trying to figure out what are the things that we can see in banks, trending in banks, that would be good predictors of failure.
Mm-hmm. Makes sense.
The number one thing that popped out, is really hard to get strong coefficients in any one variable. But one thing that kind of rose to the top, two things rose to the top, both kind of related, was growth rate and management, quality of management. Go back to the camels, the M in camels is management.
Okay.
So, I think it's ranking 1 to 5, I think is the camel rating. For each one, you're rated, for each letter, you're rated 1 to 5. 1 being really good, the best, 5 being really bad.
And I think it's for our listeners. I think it's worth pointing out this is a score that's assigned to every bank, but is not publicly disclosed. In fact, it's held under quite, I think, a cloak of darkness.
Yes.
Is for good reason, right? You wouldn't want the public to know that your bank is getting weaker because you risk a run on the bank and it becomes a self-fulfilling prophecy.
That's a topic that could be a topic for another day. So, market discipline has been argued that, we need more market discipline,
more transparency,
market discipline.
But what I described is still. Yeah. It's still the prevailing thought. Right. I get that there's a debate around it, but I think it's still true that the camel scores are not disclosed, right?
Yeah.
Okay.
And so if you get one across the board, we used to call that the picket fence. So if you get a picket fence in your bank, you're in the best possible place. You got ones across the board.
Gotcha.
So just going back to predictors of bank failures, there's kind of the management rating, growth rate, not necessarily rated, but the growth rate of a bank prior to failure was a pretty good predictor of ultimate failure. Growth rate doesn't happen without management decisions. So you can see how growth rate and management rating were very, very kind of closely related. And so, credit card banks were growing like weeds. I mean, this democratization of credit, the ability to, do balance transfers, which we like to think at Capital One we kind of invented, because you can take the best borrowers from somebody who's paying 25% and we can give them a credit card for 15%.
Right.
And those borrowers who are going to make that choice are really good borrowers. And so it was that balance transfer program was just kind of, one of the jet fuels of growth. Not only Capital One, but everybody started doing it. Mm-hmm. These monolines were growing pretty fast.
And Steve, sorry to interrupt, but one thing that I recall, I recall in the world of, this was a big, talk about jet fuel, not just for growth, but also for the growth of securitization.
Yes.
Back in those days, because as I recall, there were limits, like hard-coded limits on how quickly a bank could grow on balance sheet. And therefore, once you went over or approached that threshold, there was an incentive to do off balance sheet, i.e. securitization funding.
I don't remember there being hard-coded limits.
No? Okay.
That might have come later, but during the 90s, it wasn't.
Okay.
And I can talk about this more when I talk about my Capital One experience, but securitization, if not for securitization, there would be no Capital One. There would be no, Discover. There would be no monolines, because all of these companies were new. They were not investment grade.
Right.
Most of us had limited, the legal entity structure that we had. We were limited purpose credit card banks, which limited our ability to take deposits. We had no branch networks. And so the only real source of funding was to securitize those assets. And you point to, though, I think you're kind of pointing to, at the time in the 90s, securitization took assets off balance sheet. So they were not considered regulatory assets, if you will, for regulatory capital ratios. So it was, we talk about jet fuel. Yes, securitization was jet fuel for the growth of monolines. And of course, it, seeped out into the other consumer credit markets as well. But, we certainly were a huge issuer of asset-backed securities at Capital One, card, auto, et cetera.
So I didn't mean to rush the FDIC chapter along, but I think we were getting close to where you kind of wrapped things up, because you already mentioned Richard Fairbanks and Nigel in the co-founders of Cap One, or I guess were they already at Signet, or they went to Signet?
They went to work at Signet. Yeah, okay. They went to work at Signet, and I could talk about that experience as well. At least the stories I heard from the very, very early days of Capital One, you know, it was just a division of Signet Bank when it first started. Capital One didn't come into being until it was spun off by Signet in 94, 95. So, you know, I really enjoyed my experience at the FDIC. You know, I was getting to kind of 96, 97. DOI was up and running. All of that was great. You know, I had gone back to business school, fell in love with leadership and, you know, how that can transform organizations. And I kind of started to feel like I had more in me in terms of career growth. And, you know, again, I learned so much at the FDIC, worked with so many great people, worked on so many cool projects, but, you know, I felt like there was more that I could accomplish. And I decided, against my dad's advice, I always took my dad's advice in big moves. You know, I had reached a really high level at the FDIC at a pretty young age. I was in it's called an E2, which is senior executive service. And, you know, you typically have to be in your 50s to be at that point there. And I was kind of in my early 30s. And the chairman had left. So our sponsor had left. I was making a really good living, had a job for life. I had a 500 square foot office overlooking the south lawn of the White House. I got to see President Clinton, you know, helicopter off.
Yep.
And, you know, it's pretty cool.
Exciting stuff. Yeah.
Exciting stuff. But I felt this pull in terms of my career. And then my dad said, you haven't made there. He was a Depression era kid, right?
Mm-hmm.
I
Play it
said,
safe.
Dad, I just have to make this move. And, you know, I learned about card, subprime. A couple of folks that had left the FDIC had gone over to Capital One. And, you know, this is 97 now. Capital One, nobody knew who Capital One was. There was no Visigoths. There was no Vikings. There was no what's in your wallet. Nobody knew Capital One. Ultimately we decided to build a brand that came in kind of early 2000, 2001. But prior to that, we rode the brand of Visa and MasterCard.
Right.
And the product offerings, obviously the value delivered to customers, but nobody knew who Capital One was. And when I went over there, and this is late 97, you know, Capital One was 12 billion in assets and 4,000 employees. You know, and 18 years later, when I left, it was 300 billion and 40,000 employees. So, you know, quite a ride. But, you know, I decided to take a cut in pay, a really big cut in kind of level and prestige, because I was a really high level at the FDIC. And I went to kind of a middle level job at Capital One in 1997 because, one, learning about card and subprime was incredibly fascinating to me. And two, you know, reading everything about what the company was looking for in terms of the kinds of team they wanted to build, the people they wanted to recruit. It's like, this lined up incredibly well with what I learned in leadership at business school. This is good. This is a really cool organization. And I think it's going to have a pretty, you know, long, wide runway. And so I said, I'll take a step back for, you know, a chance to do something really great. And I decided to go over there.
Now, I want to I apologize, but I want to pause here just for a second in the narrative, because I think this is an incredibly important point that is on a lot of, I assume, a lot of listeners' minds, but certainly on a lot of mid-career people out there who feel stagnated, that their career path has stagnated where they are, and they're wrestling with this very decision that you obviously you pulled the trigger on, and you went, you know, a way that maybe most people won't go, but and that is that you had in your lap a prestigious, well-paying, comfortable job. It sounds like, that's what I'm taking away from this.
Yeah.
But it didn't fulfill going back to your kind of early 20s strategic vision for yourself, it didn't fulfill that kind of burning desire that you had. And you went with your gut here, even though, you had to kind of leave parts of your ego behind, right?
Yes.
Because you had all those things at the FDIC. So, I mean, that's a tough one. I mean, that's a really tough decision. And obviously you do very well with taking risk and working in environments where the problems that you're trying to solve are open-ended. I think that's one common thread I see when we talk about your career path is like, you seek out open-ended problems, it seems to me. And that's not for everyone. You have to know yourself, I guess, that you're gonna swim and not sink in those situations. But you swam every time. I mean, I don't know if there's anything else you can add to that, but I just see that as this is another very pivotal. You went against your father's advice, but another pivotal kind of moment that paid off for you.
Yeah, I think, again, it comes back to having a curiosity about the world and kind of figuring out meaning from that, from all the things that you learn, what it means for you, and figuring out what you want. And, there's too many people who just drift along and they'll go from job to job, really staying. Well, there used to be people at Capital One who would come to me. They were CFO of a business line. And they, what should I do? I have an opportunity to be CFO of another business line. Well, you'll learn about a different business, but, depending on what you're working back from, and for me, I wanted to work back from achieving a higher level.
Right.
You're not going to gain any incremental competencies in leading and running teams. You're just not. And so you got to make that decision. Like, what do you want and what are you working back from? I don't know what else to say to people who, unless you do that self-reflection and figure it out. And too many people, as you point out, too many people are kind of afraid of doing that. And I just didn't want to be, 45 years old and look back and say, mighta, shoulda, woulda, coulda. That was the last thing I wanted to do. And and you just got to do the work. You got to do the work, self-reflection, and figure out what it is that you want to work back from. And, again, you have to be curious. You have to figure out what is out there and what is open to you to do. You're not going to have everything, but that's okay. Through that work, you figure out what it is that you need to get there. I mean, that is somewhat consistent with our approach to strategy at Capital One. We always thought about where the world is going. Where's it going to be in the future? And what do we need to start doing today to be able to meet the world where it's going to be out in the future?
This is the Wayne Gretzky philosophy of running a bank.
Yeah, okay. Go where the puck is going, not where it is. Exactly. That's on the wall. That's on Rick Fairbanks. In his conference room, he has all of these kind of framed pieces of either data analysis or sayings like that. And that is one of them.
That's funny.
Another one is liquidity is like oxygen. Having it 99.9% of the time is not good enough.
Right.
And there's another one with the monoline graveyard, which we can talk about later. But, all those are really important principles and values that, we sometimes forget, but we, staring them in the face every day reminds us what we need to be focused on. But that's how I thought about, my career early on. And again, it's kind of a value at Capital One, thinking about strategy. That's, kind of another example of how and why I gravitated over to that company.
Gotcha.
Yeah.
Thank you.
So, I went over there to work in the corporate finance area, what we thought about, our role at the time there was one minus the rest of what the rest of Treasury was doing. So I was working on credit, the backup credit facilities, financing our own real estate, legal entity strategy, and I'll come back to that here in a second, as well as, we were starting to dip our toes into M&A. Mergers and acquisitions.
Yep.
So I did that for a while, and And then about a year later, this is probably 99, I was moved over into treasury to run the funding desk, which was primarily, the issuance of our unsecured corporate debt, either at the holding company or bank notes at the bank level, which, that's where I learned what a credit spread was. I didn't know any of this stuff. They just threw me over there and, learned from really great people that are patient with me and working with bankers again, which was pretty cool. And, I did that for a year or so. And then in 2001, after completing a really intense leadership development program at Capital One, they gave me responsibility for all of treasury.
Wow.
And I had no real understanding of securitization, which was the primary funding vehicle for the company. But
to be fair, there probably weren't very many. You probably count on one hand how many people who had real securitization experience back then.
Well, that was okay because, another important leadership principle, we had really smart, great securitization people. So I just let them do what they do best. I let great people just be great. It was, we had set up the first financial kind of planning function at Capital One, the sitting treasurer at the time, moved over to run that. They gave me responsibility for treasury in 01, even though I didn't get the title. Capital One, you have to kind of do the job for a couple of years before they give you the title. But that was okay. I didn't care. Again, I wasn't working back from titles. I was just working back from
experience.
Yeah. And so, it was just, and of course, Capital One Treasury at the time was one of the largest, most active issuers of securities in the world, right? Huge asset-backed program, credit card done in 3 countries, US, UK, Canada, 2 auto securitization programs, prime and subprime. We securitized installment loans and conduits. We had a massive, commercial paper backed conduit program that provided backup liquidity to our term issuance programs, brokered CDs in big ways. I'll come back to that in a second. Treasury, I had to learn treasury operations, interest rate risk management came back to me again.
Right.
So it was awesome. And, given how vital the capital markets were to funding Capital One. And by the way, we were growing balance sheet 25, 30, 35% a year and turning over 30% of our liabilities every year that were coming due from prior issuance.
You were busy.
And we had a decent sized subprime book, which, while we believed at Capital One and, our data and analytics supported it and our experience supported it, was the most resilient portfolio of cards in the bank. But nobody in the outside world believed that. We knew that. But nobody in the outside world, and at the end of the day, it's investors who matter. And so all of that together made it a really challenging job, but enormous amounts of fun.
What year are we talking about now?
We're talking about 2001.
Okay. So prior to the great financial crisis,
yes.
Right? So you still, I take your point then that, subprime was a tough sell.
Yeah.
Then, let's face it, it's a tough sell even today, but and it will always be that's where the risk is for sure, but it can be managed responsibly. And I will get to this, but I think in all honesty, whenever anyone asks me about, lessons learned from the great financial crisis, Cap One is always among the first companies that I point to as a company that managed the subprime risk particularly well. And we'll get to why later. I don't want to give too much away now. I don't want to interrupt the narrative, but it's absolutely true from an observer's perspective. So I'm curious to see how you did it from the inside.
Yeah. The other, perhaps the most important thing for me in kind of jumping into this role was, given how vital the capital markets were to funding the growth of the company.
Mm-hmm.
Capital One Treasury was an important strategic part of the conversation for overall corporate strategy. So I became a demanded participant at the strategy table at the highest level. I spent, good chunks of my time on a weekly basis in Rich Fairbank's conference room. I was involved in all of kind of the business line, report meetings. I had to understand where the company was going in order to figure out how I was going to fund it. I had to provide, the market intel from the capital markets back into the business so they would understand, hey guys,
there's only so much capacity at this spread.
Yes.
And at this term. And all these things.
Spread, we didn't care about spread because we were making so much money, but it was more about capacity at that point. So,
fair point.
So I had achieved my career objective in 2001 in that I was at the strategy table working with all the senior exec, the CEO, who's a brilliant strategy guy. I'm sitting in there, for chunks of time every week, figuring out where this company is going. Cause it wasn't my job to provide, I had to provide it in advance.
Right.
So they were confident that when they executed,
of course,
the funding was there. So I had accomplished what I had set out to do. This was the coolest thing. Now, that growth story at Capital One wasn't always smooth sailing.
Sure.
And so in 2002, I'm a year in the seat. It actually began in 2001 in the other monolines where the Federal Reserve was going around. They kind of read my financial institution letter over there. And they started rolling into the monolines. We're talking about the Providians, the Metruses of the world.
Knocking on your doors.
And they were slapping them silly. And, in 2002, they came in and they, slapped us with what's called a memorandum of understanding, an MOU, and it had nothing to do with our credit performance. It had nothing to do with our profitability. All of those metrics were still outstanding. It had to do with the lack of robustness in your back office infrastructure. I could see that. We didn't have org charts. We were growing so fast internally with people. Our org charts were obsolete by the hour. Okay, we know that. Now, where the story is going is that both Rich and Nigel had and still have strong moral and ethical compasses. No banks ever publicize the fact that they had a regulatory event like that. But to their credit, Rich and Nigel said, at some point, even the slightest impact on our financial performance that may come from this is something investors ought to know. So after a lot of internal debate, of course, at the end of the day, it's their call. We disclosed the MOU in our July 2002 earnings call. And the results were almost catastrophic. So the stock fell 50% in one day. And we were completely shut out of the capital markets, which for what turned out to be a year.
Which is pretty devastating. That's a devastating impact. I just want to point. I remember this, by the way. I was a young, junior analyst at Moody's at that time. I can remember that's how big of a deal this was in the capital markets, and certainly in my space. And MOU was. I think the fear was, even though you have all of this context that you've added, is like it was back office, it was more operational or administrative. It wasn't credit, in other words. The fear was as if there's smoke, there's fire. And if they broke tradition by disclosing it, then they didn't see the kind of what if you would call it transparency / ethical motivation. They saw something more nefarious going on, or I think that's what my interpretation of the market response to this. I know my recollection is too, at least from the credit analyst perspective was, how do you think about, and this not just for Cap One, but for any bank that you become aware has an MOU, on the one hand, now something now you do have it. Back to your point from a while ago, now you have transparency where you had none, and isn't that a positive thing, not a negative thing, right? I mean, but the market doesn't always see it that way. They take their pound of flesh and so on. So anyway,
I'm glad you pointed that out, Will, because I left out another thing that we disclosed.
Yeah.
And I argued for this, and Rich resisted, but ultimately he went along with it. And, it was a disclosure of the distribution of FICO scores in the card book, which showed us at about 30%. So everybody knew we did subprime, but nobody, everybody thought it was massive. We didn't think it was massive. The reason why I argued that is I was telling Rich, listen, all my investors are pushing me for this data.
Mm-hmm.
And if we show, and we showed it compared to others, I don't think we named the others, but we certainly had access to what we call testbed data, which had the FICO distributions at other large issuers.
Mm-hmm.
Ours wasn't really any greater than any of the other ones. And so I said, Rich, compared to the other ones, we're not that bad. We're kind of in there. He didn't want to do it. He went along with me. And, I think that had something to do with it. To your point about everybody wants transparency, but when they get it, they don't credit you for anything.
Right.
They just take their pound of flesh. And I don't think Rich ever forgave me for that one, but it is what it is. And, it does help explain. It did help explain kind of why our risk-adjusted margins, we still had really competitive loss rates, but our, margins were huge because we did that subprime business really, really well.
Mm-hmm.
So how we survived that crisis was, going back to 2001 when I first stepped into the seat and kind of understand, hearing the chatter about what was going on in the other monolines. And that, I just felt that's, ultimately they're going to roll in here and slap us around too. And so in the summer of 2001, I stepped on the gas on brokered CDs. And we took, because we had no branches, we had a telephone, essentially a telephone bank, if you will, bank of telephones, where we were able to take deposits over the phone.
Yep.
And, I was run by Capital One people, and I just had pedal to the metal.
These are retail deposits.
But we couldn't take deposits under the insurance limit. I mean, because of the limited purpose credit card bank. And
so they were jumbo.
They were jumbos, yeah. Okay. Big dollar deposits.
Yep.
And we built a war chest of significant size, which turned out to be life-saving. We got through that year period. Now, an interesting kind of side story was that, early on when I joined Capital in 1999, given my regulatory background and having learned how we were funding this business, I put together a presentation to Rich and Nigel. I said, we should become a bank holding company, because up till now we weren't. And the reason why we were not a bank holding company is because we thought the information-based strategy, which was to use all of this data on consumers and kind of risk-based pricing, we thought that could be used to do non-financial services stuff. And then a big example of that was we actually were trying in the late 90s to become a large reseller of cellular airtime. Cell phones were just coming into vogue. We would be able to buy cell time from big companies and resell it, using our customer data to identify customers and make offers on cellular airtime. Well, you can't do that if you're a bank holding company. And we were making huge investments in that business.
I
And
did not know that. That's
yeah,
interesting.
and it's called America One. And, but I went in 1999 with a presentation to Rich and Nigel and said, listen, we need to become a bank holding company because at some point we're going to reach funding constraints. And this is a really risky way to fund the company. It's growing like this. And we got
Let's just freeze I'm not going to ask you for a detailed recollection, but just big numbers, pie chart of your funding profile. Then we're talking about, I don't know, I'm going to guess 70+% in term securitization funding.
Yes.
Plus you had to add to that some 5-10% in short-term conduit funding, which is basically securitization funding, in another name.
Yes.
And then you had the rest. What would that be? Bank deposits, which is a small sliver?
That would be, those kind of wholesale, let's call them wholesale deposits.
Wholesale deposits.
They were big dollar deposits from retail and brokered.
But I'm trying to paint a picture here for listeners is that I can see why you were concerned, right? Because you're looking at this pie and you're saying everything depends on our continued access to the term capital markets, to the term securitization markets. And I don't know if you made this. I think you're making the case that you observed this prior to the MOU and started saying we need to have a plan B / dry powder for what happens. By the way, it could have been an MOU or it could have been something exogenous to Cap One, right? Which happened also,
exactly.
Right?
So I used to say to Rich, I said, literally there's only about 20 or 30 people, individual investors.
Yeah, right.
Make the decision on our company funding every day. And they're all 25 years old. And if they get, they get hung over one, they come in the office and they see a headline in the paper, they're gonna decide no, and then we're in deep doo doo. That's just kind of hyperbole for this kind of the situation, but it turned out ultimately to manifest, too. But so I was making this recommendation. They patted me on the head in a nice way, kicked me out of the office. Yeah, no, that's okay. We don't need one of those. And on an annual pilgrimage, I would tweak the presentation with another angle on the story and go back. In 2000, 2001, they would very nicely escort me out and say, that's okay, Steve, we don't need one of those. And then,
sorry, again, the friction here is, it buys you access to retail deposit taking and all that funding that comes with that. So you diversify your funding profile almost overnight.
Yeah.
But then you also invite the regulators into your house full time. So I guess that's the friction that Richard Fairbanks were.
The friction was, we had regulators in house all the time, but the friction was we would not be able to to extract the value we saw in using information.
Right. In these other business lines, that were prohibited. Okay, gotcha.
That was the friction.
Gotcha.
Try to calculate the value of that and kind of work that back in. I calculated the funding savings we would have if we went retail deposits versus, how big would a non-financial business have to be, to justify, having, not having lower cost funding, I was trying to think of everything.
Yeah. That makes sense.
Yeah. And, it wasn't until 2002 and experiencing that kind of near death experience, that we decided to start to explore, okay, so what would that look like? And then it took us a couple years to figure it out. And then in 2005, we made our first acquisition into the banking space, buying Hibernia Bank, which had a big retail network in Louisiana and Texas. Texas was fast growing at the time. And, almost overnight, we got a ratings upgrade, became an investment grade holding company. Mm-hmm. And then we were off to the races. And we followed on with acquisitions of North Fork Bank, which is a much larger bank, based in the New York City area. And then ultimately, as we got closer to the banking crisis, the great financial crisis, we bought Chevy Chase Bank in DC. And
so you started getting some mortgage exposure at that point too.
Very little, though.
Just very little. Okay,
Yeah,
just regional, I guess. Okay.
Yeah, very little.
Okay.
Never was a big. I don't think Capital One was ever a big fan of more. It's not really a credit business. It's really an interest rate risk business.
Right. I was going to say spread. Yeah.
Yeah, and so not a whole lot of we never saw a whole lot of value in the business, but so we completely transformed the risk profile of the liability side of our balance sheet by going into retail branch banking, which was huge for us, and but it was also huge for me personally. So as a result, we became less active in the capital markets, doing less securitization, and with it, treasury became less strategic because we were getting a lot of our funding from good old retail deposits, which is awesome. It's better for the company, but for me personally, it's like, okay. And so I started to think, well, maybe I should go do something else. And then the great financial crisis hit. And, with that came its own set of challenges, which was really cool, right? We had totally transformed the liability side of the balance sheet. We did not sweat one bullet in terms of funding the company in the great financial crisis. In fact, I won't name them, but I had investment banks calling me asking whether we would make them loans. That's how bad it got, obviously. We all know that story.
Right.
And we had a lot of capital. We did a secondary common offer. We had a reverse inquiry to do a block trade. And, to Rich's credit, we didn't need the capital, but someone was coming in willing to pay a pretty good price for the stock relative to where it was. And, I went up. Rich said, yeah, let's do it. And because it's always like, if it's there, if it's, if the cookie's being passed around the table, take one. And it turned out to be awesome because, one, it helped us on the capital ratio side, but it also helped capitalize our acquisition of Chevy Chase Bank, which was during the early days of the crisis. So to his credit, very conservative in terms of, wanting to have a lot of capital available to us, whether it's for, tough things that are happening or whether it's to seize opportunities in the market. And I remember, this is kind of the time of the TARP too, right?
Yep.
And
TALF.
Yeah, TALF. Yeah, all the acronyms. And, we got a fax from the U.S. Treasury Department said, how much TARP do you want? And I filled out the form. We had Rich sign it, blah, blah. It had zeros. We don't need any of this TARP. And we faxed it back. And about an hour later, we got a call from, I think it might have been an undersecretary of the Treasury. It says,
we think you need some.
I don't think you understand. This is not, you have to take it.
Right.
And why did we have to take it? Well, all the big banks had to take it, whether they needed it or not, because there were some that really needed it. And, unfortunately, we got brushed with the same kind of stuff the other guys did, even though we didn't need it. And it cost us a pretty penny because with that TARP came warrants. And those warrants turned out to be extraordinarily expensive to get out of.
Maybe we need to explain that a little bit for listeners who may not have been working during that time. But this is the great financial crisis. There was a huge banking crisis going on. And I think TARP, if I'm not mistaken, that was promulgated by the Treasury, right?
Yes.
Yeah, the Treasury. Yes. And I think TALF, which I don't know if we'll go into that or not, was the Federal Reserve. So, but they had similar aims from a big picture perspective.
Yeah, but TARP was essentially
troubled asset. What's the R?
No, TARP was basically the preferred stock that the government would take
But it was. I think the acronym didn't it stand for Troubled Asset Something Program?
I thought the TALF was the asset back, the kind of the asset back program,
Okay.
where you could pledge assets. It's provided liquidity. The TARP it provided equity.
Okay, so they injected equity capital into the firms that basically there's like an offer you couldn't refuse, as you put it.
Yep.
And that was to provide cover, essentially, to ensure that there was no misperception or perception that any bank taking TARP was destined for failure.
Right.
Again, it was kind of this psychological run on the bank concern, run on the institution concern. So everyone took TARP. And it had a warrant attached to it, 5% stake of, I think, preferred stock that then would, if you didn't pay it back within a set period of time, would jump up to something higher. So basically you incentivized to pay it back within that period of time. I don't remember what the period of time was.
Yeah, I don't remember this. I do specifically remember because it just pissed me off.
An offer you cannot refuse.
The cost of getting out of that warrant was pretty high for our shareholders.
I bet.
Particularly given the fact we didn't need it.
Right. But I'm trying to think back of my thinking of Capital One at that time and credit card banks in general at that time. This is the great financial crisis, and there was double-digit unemployment rate. We were talking then about the 2 out of the 3 Detroit 3 auto manufacturers actually did file for bankruptcy. And there was concern about Chapter 7, not reorganization, but Chapter 7, right? Where you were talking about hundreds of thousands of people out of work at the same time. I mean, it was a real looking down the abyss kind of moment for many of us. And I learned a lot, but there was a lot of anxiety during that time. And going back to my thoughts around Cap One then was, we all knew, I think, certainly working at a rating agency, we knew there was some subprime exposure there. And it was still untested in the sense that, we knew it was riskier. We had been told, of course, by every issuer that they had their arms around the risk. Don't worry, right? Yeah. We're doing it responsibly. We're doing it right. Well, it turns out that some are doing it more responsibly than others. Some were getting the risk dialed in right. Capital One happens to be one of those companies, as I said before, was one of those companies that was getting it right. How are they getting it right? In one big way, again, this is, I'm sure, a gross generalization, but one way they differentiated themselves was they just didn't issue that big a line of credit to the subprime folks. Whereas other credit card issuers, they would graduate these subprime, they would start them off small, but within, you blink your eyes and in 2 years, they would have lines that were $10,000 or something way outside of what they ought to have had given their risk profile that they demonstrate. And you can imagine this is a very, that's how you grow. That's one way to grow balances. And, you got to answer to shareholders, and it's got to be an attractive lever to pull from one perspective or another. But man, if you have your eye on the long-term kind of risk return quotient for your company, which apparently Cap One had, that kind of prescience, then you keep the lines low. And that's what you did. And I think that's why Cap One, just like everybody else, experienced much higher losses during that period for obvious reasons, but much less than I think what people had feared. And, the proof is in the pudding, as they say.
Yeah. The low line strategy was key. And, we followed the same strategy at FairSquare, the startup we did. And, it's essentially doing all the analytics. The analytics, our NPV models just pointed us to that outcome. Mm-hmm. And it embedded in those analytics was stress testing. Yep. So we would build into those NPV models the analytics that, what if losses go up X%? Where does the thing go negative in terms of NPV? And so we had, we set bars for those products such that they
on the origination side, though. I think that's the important thing, right?
on the origination side, these things have to be resilient.
Yep.
Or else we're just not going to do it. And it kind of leads you to that place where, in these segments, we always believed that the prime segment was the riskiest one because you couldn't really price that high. And in order to get, a competitive product out there against what the competitors were doing, you had to have a really big line. We felt like the risk of somebody going bad was not materially different than subprime. Yeah, it's different, but not material. But the line size is so much greater. And so, we used to talk about the barbell. We had super prime, big super prime book, had the third, 30% in sub, but under 660. But you had a pretty narrow segment in the middle called the prime segment because the lines were big, and you really couldn't price for the risk.
Sorry, I just want to make sure, again, we're bringing people along and we're talking about lines here. Credit cards, I think, are probably the most ubiquitous consumer credit product out there. But when it comes to managing risk perspective, the credit card companies set the lines and they'll move them both up and down, usually up over time, depending on credit and depending on the consumer or the cardholder's behavior, right? Yeah. And what you notice is that, people will use closer to their limit if they're credit needy, and they'll use less of their limit if they don't need the credit as much. And that tends to create this interesting kind of dynamic where you have the people who don't need the credit have the biggest credit lines. I mean, this is the world over, right? This is credit. Yeah. The people who don't need credit the most have the biggest availability, and the people who need it the most have much less availability. And what people were concerned with, and this actually did happen, is that when the people who need it find themselves in out of work or what have you, then they will use every bit of that line and then some. That's right. And then they're really at risk of going, charging off, of becoming a loss. And it becomes almost a self-fulfilling prophecy. And then, your loss severities, as we say in the business, go way, way up. And that was the dynamic that I think, again, Capital One showed some discipline around, and others didn't. So it was a ready, aim, shoot from Cap One. It was a ready, shoot, aim from other unnamed issuers. Yeah,
getting line size and utilization rate. The utilization rate is really, really important in credit card. And
ahead of time.
Yeah,
right.
yeah, absolutely. And and this is all of that coming out of a huge committed program of test and learn. So testing every aspect of the product and segments is what built the information based upon off of which we made that marginal decision to book another customer. So
you were doing again. I want to underscore this point about Cap One because this is my recollection as well. Looking across your competitors, I think you had you all had access to a lot of data, but I think Capital One was putting that to work with more precision. I mean, we're talking about, I just underscore, on a cardholder by cardholder basis, you were making these kind of NPV calculations, as I recall.
Yeah.
It wasn't done like 10,000 foot portfolio level. This was like very, very granular analysis.
Yes.
Which is now very common.
Yeah, it's common.
But back in the day, this was something that was on the cutting edge for sure.
Yeah, I think what helped us was we had that was our core business.
Yeah.
The other our big competitors were the card business. Well, they were big, but they were part of much larger organizations.
Right.
And so decisions to spend marketing dollars. For us, that's what we're about. That's everything. And so we were really, careful about how we did that. In other banks, that marketing budget could be jerked around, and to suit whatever new objective is coming down the pike in that bank. And for us, it was this is our business. This is what we do.
I mean, there were other monolines around, like MBNA comes to mind. You mentioned Providian, although they started to diversify towards the end before they failed. But they had different. You each had your own kind of lane. That was a little bit. It was distinct enough.
Yes.
So that you weren't like completely overlapping. But and then, as I'm sure you're going to point out, the monolines. Eventually, that model kind of wore out its usefulness.
Yes, they entered the monoline graveyard.
Right.
As we used to say. Yeah. So, I guess, we powered through the great financial crisis. It actually led us to, more opportunities. We used to think don't waste a good crisis.
Right.
We eventually went on to buy, ING Direct, and which was the largest, internet deposit business in the world at the time, which further just added to the heft of the deposit side. So, I was in 2011, 12, 13. In the wake of the GFC, Dodd-Frank came out, that totally kind of changed regulation of banks. The stress test came out. All of those two things really impacted balance sheet. And that was my job, managing balance sheet. I became the co-lead with our chief credit officer, chief risk officer at the bank, for our CCAR process. We passed every year that I was co-leading that, that day job of doing transactions every day was kind of gone away. So I started to get itchy feet. In the wake of Dodd-Frank, which again was a law, but regulators are then tasked to go out and promulgate rules that support the law.
Right.
And so we did have opportunities to shape that. Since a lot of it was balance sheet management, I was totally immersed in all of that, and I enjoyed from the funding days, enjoyed dealing with investors. In doing outreach, and I formed a regional bank treasurers group, which came together in the wake of Dodd-Frank to kind of exchange best practices. How are we going to deal with this? Blah, 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 blah. And to also do advocacy work, meeting with, I would lead the delegation, go do the presentations with, Janet Yellen, who was a board governor at the time, not the chairwoman of the Fed, but, people like that, the comptroller.
Now, you're still at Cap One at this point?
Still at Cap One, yeah. Okay. So, since everybody, all those, regulatory bodies are in DC, I would, sponsor meetings of the regional bank treasurers here in DC. We'd spend some time just sharing best practices on how to deal with all, the LCR and all these other kind of new regulations coming down. And we would also go and kind of do advocacy work on Capitol Hill and with the agencies about, how these rules would impact banks, if they were implemented in a certain way. And I really enjoyed that stuff. And then, about 2014, I got tired of just dealing with regulatory stuff and doing very little of kind of the fun stuff. And I decided to hang him up. I left in early 2015. And, I had previously bought a place here on the Chesapeake Bay and said, I'm going to just hang out and maybe do some consulting on CCAR, or do leadership development or leadership coaching. And that would be my life. And
that sounds like a pretty good life.
Yeah. And then, in the late summer of 2015, I get a call from an industry legend, Steve Freiberg, who was ex-CEO at E-Trade. He had run all of Citigroup's consumer finance business. And he asked whether or not I'd be interested in joining a startup credit card company.
So now comes the pulled back out of the Chesapeake Bay idyllic retirement life, and you get this knock on the door. And tell us about that. I think this is I mean, such a icing on the cake, if you want to call it that, in terms of your career trajectory. What a nice opportunity this is.
Yeah. So, one of the things I just truly loved about being part of Treasury at Capital One was just the people I got to work with, and incredibly talented, but just really smart, funny, just great people. And, I could barely sit, in my office. I had a tiny office at Capital One, only because I wanted further incentive just to be out of that office and it just rolling around the floor and talking to people. And I was sitting here in my house and it became lonely. And the whole thing is a tough business where you just work it by yourself. And I yearn for that kind of human interaction again.
Yep.
And I got this call from Steve, and he said, listen, we're going to start this credit card company. It's going to be well capitalized. And Rob Habgood is going to be the CEO. Rob and I worked at Capital One. Rob was sent, and I think he might have been still in his 20s, was sent to the UK by Capital One to start the UK credit card business, which he built from scratch to like $7 billion in, a relatively short order. So he's a great guy. Had to work with him to figure out how we're going to fund that business. And I said, wow, I get to work with Rob. This could be really cool. This could be Capital One circa 1990s 2.0.
Right.
I'm in. And so I went off with Rob, and, he brought along, Rob had moved on from Capital One, who was at B of A, helping to turn around that credit card business, which had kind of suffered, it didn't do well with the MBNA acquisition. And Rob, was basically charged with turning that around. And he's based in Wilmington. That business was based in Wilmington, Delaware. And he had some really great people working for him in marketing and ops and credit. And he brought along those folks, and this could be a lot of fun. So we started to gather. I would drive the 90 miles from Annapolis up to Wilmington, and we just got on a whiteboard and we just mapped out how we were going to pull this business together. And we started to do that in early 2016, and we had to figure out what we were going to call it. Had to get a business license, and we were talking about, advice for entrepreneurs. I was doing stuff like, trying to find, where we're going to buy pencils,
Right.
when are we, all of this stuff, which was a blast, because we were really building this thing straight out of the ground. And we were, quite fortunate to have exceptional, private equity partners. Pinebrook Road Partners was kind of our lead private equity firm, and they understood the business really well. They convinced all these folks to come work there, and it was a really great partnership to help us get this thing off the ground.
Now, here's the thing. I mean, we're going to have a lot. I think we're going to have a lot of listeners who are in entrepreneurial roles, or in this round or that round of their kind of startup venture in the fintech sector in particular. Very hot segment right now in terms of consumer credit, consumer finance, and you're describing this kind of entry point into your entrepreneurial chapter with the good fortune of being well capitalized from day one. But I think, as I look at it, I'm like, there's a chicken or egg kind of question here. Is like, did you get well capitalized from day one because there was a tremendous amount of track record trust in you and the rest of the management team that was put together, or was it because you had or was it? I really don't believe it was just pure luck, right?
No.
that you fell into this. I mean, I think that is exactly what the dynamic, and that differs from a lot of startups out there today that have to either that they're often, not always, often very young and inexperienced. They have the energy and the idea or the germ of an idea, a business model that is novel or that may have legs, but they don't have the track record of execution in this lane of credit, consumer credit, that you and the rest of the management team at FairSquare had.
Yeah.
And that afforded you then this stockpile of capital that it kind of, it just eased the path. I don't know how common that is. I suspect it's not that common. Right?
Yeah, I never thought of or spoke about with prospective lenders that we spoke about the company in the context of being a fintech, and I just didn't think we were. And what I mean by that was a couple things. One, we were our product. And by the way, that equity commitment also, as a result of all these things I'm about to say, one of the first and foremost is that the credit card product and the one that we were going to be issuing looked very similar to every credit card that had been issued since the 1990s. It's the same thing. We are not transforming the credit card product. It's the same.
Right.
That, coupled with the fact that you got a bunch of people, men and women, who have decades of experience in this business,
right,
going back to the 90s together. Third, we weren't writing code. We weren't creating new technologies.
Right.
We were simply taking tried and true technologies and partners who provided those technologies that have been around for decades as well.
Right.
So all those things together, you have a lucrative, it is by far the world's best consumer credit asset at its core, best risk-adjusted margins, resilient through
still.
So you have that, and we're not reinventing technologies to kind of deliver any of that. I mean, we started the company with direct mail, been around since the 90s. I think really reduced the risk of failure in this thing, which I think helped on the equity side. I would sit down with lenders. I sit down with you guys, rating agencies, when we're trying to get a rating on our first deal. It's like, this is just like your father's Oldsmobile. For those of us who've been around a long time, Oldsmobile used to be a car maker. I don't know if they still make cars, but they used to say, this is not your father's Oldsmobile when you're coming out with a new model.
Right.
They say, this is your father's Oldsmobile. It's the same thing. And what's critical about that is that there's so much data on the product that goes back decades. So every rating agency, every investor, fixed income investor, has the data on this thing, which I think is different than companies trying to go out there. And then I can talk about fintechs.
But sorry, Steve, but that is very true, and that's true. It's also true in other sectors within consumer credit where you see new entrants come in and they say, "Well, you have all the data on whatever auto lending. You know how that works through cycles, and why do you need 4 or 5 years or whatever the threshold is for a track record?" The answer isn't. It's not so much about the. I mean, usually you're talking about, as you said, they're not reinventing the credit product itself, but you don't have the track record of the management of that business. That's the key missing ingredient that you had with your team at FairSquare.
Yes, absolutely. Like I said, the management team, and in fact, it turned out to be pretty much everybody at FairSquare had, at least 10 years. Most of us had 20 years of experience in this. So we knew how to operate a credit card business. And I think that went a long way. In the end, is probably true in a lot of businesses. Trust is one of the most important things that you need to have. And I think people trusted us to do the right thing, to run the business well, and to do the right thing. And like all the lenders, most of the lenders I dealt with, they knew me going way back. And so, there's a trust factor there that helped us on the funding side. I think and as well as with all the management team, we had strong, stellar, track records of operating a card business.
You probably don't remember this. It would be something that I could imagine people missing. But at the entrance of the old Moody's headquarters, 99 Church Street, there was a phrase there that had a quote, or the name of it. The name of the phrase was "Man's Trusted Man" or something like that. Yeah. Credit Man's Trusted Man. Yeah. And then it had a quotation, a longer one that I can't remember, from Daniel Webster back in from the late 1800s, I think. Yeah, that Daniel Webster, the dictionary Daniel Webster. Yeah. So it goes back to the what you just said, and it goes back to trust.
Yes.
At the end of the day, credit is trust.
Absolutely. Yeah. So the fundamental rationale for FairSquare was that we believed that there was still a very large population of underserved people out there in terms of credit cards. In the wake of the great financial crisis, a lot of the big players retreated. And, with the exception of Capital One, Capital One never retreated. But, nobody was going back in. And Capital One, ultimately was our biggest competitor in the space. But the space was $200 billion plus in outstandings, close to 80 million in accounts out there, growing at 7% a year. So there was a really good kind of market that we could go after that, we felt were not being served well. The benchmark data that we were using kind of underlined the business case for the company was, loss rates the net loss rate around 6%, risk adjusted margins in the 15% range. So the business looked pretty solid. And again, that also a driver of the the equity backing. The underserved segment we like to call near prime, where we were playing was like 600 to 700 FICOs. We were doing a little under, in the high fives and in kind of the low sevens, but our sweet spot was 600 to 700 FICO when we're trying to produce a book, with that loss rate, and have kind of the weight of the portfolio kind of in the 660 FICO range, which is kind of the regulatory definition of subprime.
Right.
What would differentiate us? We like to kind of think that our products, and we some of this we heard in kind of focus groups, was that people didn't really care so much about the APR. They just didn't want to they didn't want gotcha fees. So our products were pretty straightforward. We tried to create transparency, tried to be really clear about how the product worked. APR is this. There are no fees on this product except for late. If you're going to be late, we're going to charge you a fee. And our fee was kind of in the zip code of where everybody else was. That's going to be the product. We tried to create our marketing materials that kind of expressed, openness, friendliness about the company, and again, being really transparent about the products. We came up, the company's name was FairSquare, but we came up with a product name for the card called OLLO, OLLO, which meant nothing. There's no meaning behind OLLO. It just, to us, it just kind of sounded open, and that was
Mm-hmm.
the product name that we brought, and it kind of lined up with the impression or the feel that we wanted customers to have with every interaction. Open, friendly, transparent. That was kind of what was behind the marketing for the company. I think another key strategy of the company from the credit perspective was doing everything on a pre-approved basis. So we would use all the data analytics to identify subsections of the population that we believe were going to be good. We sent them direct mail. And even though they got direct mail, another big piece of the strategy was we were going to be digital first, which meant in order for you to apply, you have to go online and apply.
Right.
Which meant that we could capture more data in that application online, which helped us ultimately make that credit decision, which happened basically in real time. And the biggest decision we were making there was the size of the line. So a customer would get a piece of mail. It says you get a 25% APR product, no fees, except late fees. Come here and apply.
So let me just boil that down a little, break that down a little bit, because pre-approval, again, for folks who aren't super familiar, this is it was super commonplace back in the day, where you would get a letter in the mail that said you've been pre-approved for a line. Turns out that can be somewhat risky, because the time that can elapse between when you get the piece of mail, when you respond to it, your credit profile may have changed for the worse, and often did. So now what you typically get in the mail, if I'm not mistaken, is something that says you've been pre-selected or words to that effect, but they're not. It
used to be pre-selected. Now it's pre-approved. So what we were doing was pre-approved. I think before it was pre-selected.
Pre-select. Okay, so I got the vernacular wrong, but the decision was done. My point is that you guys were making decisions to grant credit up front, but then you dialed it in when they filled out the application online. Is that how it worked?
They had a really good odds of being approved.
Right. Okay.
Because we selected them. And ultimately, that final credit decision using additional data, like do you have a bank account? Do you have a checking account? Really determine the line size. So to your point, sometimes credit scores drift between the time the mail goes out, by the time they get the mail and are applying. There's drift there. So between drift and the additional data that we're collecting upon application, we would determine the size of the line. And in our case, our line sizes were like 1,200 to 2,000, the initial line size. Now, also in those mailings, we would make a promise that if you made 6 consecutive payments, we would increase your line.
Gotcha.
You would be eligible for a line increase.
Right.
That's what was attractive. So,
incentive for good credit behavior.
Yes, exactly.
Yeah.
So grow with them as they demonstrate that they can handle the credit. So that digital first strategy, meant a couple other things as well. We developed a really kind of best in class mobile app that allowed a customer to self-serve everything they do online, which really helped on the cost side. So if you get people to do what they need to do by themselves instead of calling the call center, that really helped on our operating costs. Also, that's a really great way to engage with them. We could send them, texts. We could send them, alerts through their apps that said, "Oh, hey, your payment's coming up," or you missed a payment, or whatever, which helped on the engagement side, so we get stickier customers, and it also helped on the risk side. So, so being digital was so beneficial from so many perspectives: cost, risk, engagement. And I'll talk about the infrastructure here in a minute, but so underpinning all of that at FairSquare, certainly starting out, we started off slow, was test and learn. Another page of the Capital One playbook, test and learn.
Right.
Started off with really small mailings in 2016. We had spent the summer of 16 building out the infrastructure, and I'll talk about that here in a second. But building the infrastructure, finding the operations partners, the marketing engines, all these things, these credit engines. We spent the summer of 16 putting all that together, and started to do test mailings at the end of 16 and throughout 17. And, like any test and learn program, you put out a test, you start to incubate the results. You take the results of those tests and you just cycle them in a really quick, iterative way into improving your models on the fly through time. And, by 2018, we were getting a lot of what we call on-us data, which allowed us to make, quantum leaps in improvement in the, credit quality of the assets that we were generating and really getting to where our target wanted to be. That's just, another Capital One, approach. It's just test and learn. There's so much value that comes out of doing that. And it really reduces your risk because you're only going to make big investments in those, big investments in rollouts in those tests that demonstrate real value.
Right.
Hitting your risk-adjusted margin metrics.
You're describing, in so many ways, a business model. I look. There were other companies doing similar things. I'll call it, in terms of, but not quite the same. And I think you were a bit ahead of your time in this regard. So you had. We already talked about, key experience management and what I'll call patient and plentiful capital,
yes.
Relatively speaking. But you also, part of your business model that I think allowed you to be very nimble and iterative and responsive to in a test and learn environment, which is critical in credit cards and probably any fast turning consumer credit product, is you farmed out a lot of the operational and other kind of legs to the stool of the business.
Yes.
You didn't feel it necessary to build those things yourself, and that would have been not only more time consuming, it would have taken more managerial time to manage those functions organically, build and manage those organically. But you were able to farm those out and still manage them, obviously. And these were at this point discrete operational legs. If it wasn't the bank itself, it was the servicing function. I think you mentioned marketing as well. So all of these kind of core functions you were able to manage through a network of third-party partners, right?
Yeah, so talk a bit about the infrastructure approach, and so it structurally, just from an equity perspective, we were really fortunate with our Pinebrook partners that they were able to get LPs to kind of back what we called a line of equity. Mm-hmm. And we had an initial line of equity of $200 million. It was pretty sizable. And we were able to just draw down that equity gradually as the company grew. So we didn't have to take it all up front, which creates enormous pressure to do something with it. We were able to take it down as needed. And knowing that you have up to $200 million there, we didn't have to worry about, additional rounds of equity raising.
Right.
So we were able to just focus on building a great business. And a couple of years later, we did add another $100 million, but and that was through Ateros, which is the investment arm at Comcast, money managed by Vikram Pandit, who is on our board. His investment group, or the Origin Group.
The former CEO of Citi.
Yeah. Mm-hmm. So Vikram was on our board. It was the fact that he was, basically the leader in this idea of creating this business.
Oh, wow. Okay.
Yeah. He felt,
That was after he left Citi then.
Yeah. Oh, yeah.
Okay.
Yeah. Well after. Well after. But to be honest, that additional 100 million, we did very little work in having to get that additional money. We hadn't even gone through, I think, 100 million of the initial 200. The business was being built really kind of flawlessly at that point, and it's about 2018. And so it wasn't a hard sell. So in terms of just continuing on with the infrastructure, and this is a really critical piece, as you pointed out, we essentially partnered with well-established companies and technologies that they had to do operations, for example. So we outsourced operations of the card business to CardWorks, which has their own card business, and some of it in the subprime space, who had they did essentially card as a service from an operations perspective. And they did, kind of our back office functions in supporting card operations. And they did the call center work, and they did collections. So we didn't need to hire all those people to do it. They were well established. They knew what they were doing. And so, we de-risked all of that by using and they've been around a long time, really long time.
They're pretty well known. Yep.
Yeah, they're pretty well, and they do a great job. And they, in fact, sit their kind of operational platform on Fiserv, which
everybody uses.
Well, everybody uses the cardholder system.
Right.
That's the kind of system of record. And so, again, well established. So we weren't building our own systems. Didn't have to worry about that. Now, we did have a deeply experienced operations team at FairSquare that we had got from other banks,
right,
who rode shotgun,
right,
over that. We created the strategies for collections. We created the scripts for the call centers,
right.
Created the strategies to set up the cards on the systems. So we drove strategy, CardWorks implemented. So it's not that we fire and forget. We manage those businesses, those operations very closely.
Right.
But we de-risked a big part of the business by doing that. The mobile app. We didn't develop the mobile app out of the ground. The mobile app was built on kind of the bone structure that existed at CardWorks. That little, kind of technology arm. We just leveraged that. We brought our own, magic dust to it.
Right.
And designed it in a way that fit our business. And, we're fortunate, it's a great app, but it was only about one product. Every bank has their apps, but they have to support a variety of products. For us, it was easy because it's one product.
Right.
So, we de-risked a lot of, starting this company by, having, it's a proven product, proven back office function, and with all that equity behind it. And the other aspect from an infrastructure perspective, we're not a bank. Right. And in the United States, to be able to issue a credit card, you have to have a bank charter, and you have to have a bank identification number to be able to be set up on Visa or MasterCard to issue those cards. So we were not a bank. And therefore, we had to use the bank sponsor model. There are a bunch of banks out there. They're smaller banks who have their business. Big part of their business is to be sponsors for other lenders, which essentially is contributing their bank identification number to the whole kind of sauce. We hooked up with Mid-America Bank in Missouri, got acquired by Bank of Missouri. But they were, terrific partners, throughout, despite their acquisition, all the way up to, the acquisition of FairSquare in 2021 by Ally Financial.
And just to explain that a little bit. I don't. That could be its own podcast. But the bank partner model is basically, as you said, you're using the license or the charter of the bank to issue the credit cards, but the bank doesn't hold the receivable usually for more than a couple of days, sometimes a little longer. And those receivables as they're generated. So as those cardholders use the card to pay for whatever they're paying for, a receivable, an asset is generated on the account, and that is then sold within, usually, like I said, within a couple of days to the finance company. In this case, FairSquare would purchase those receivables. Is that how it worked with FairSquare?
Correct.
Yeah.
So the bank sponsors the technical legal owner of the account.
Right. That's important.
While OLLO was on the front of the card, on the back of the card in small print was Mid-America Bank, or the Bank of Missouri. They were the legal owner of the account, but those were the receivables generated by that account was transferred to us, FairSquare, on a daily basis.
And the bank gets some type of revenue or fee stream for taking on that role.
Yes.
The partner bank does. You're also paying, I should have mentioned, a servicing fee to, in this case, CardWorks for the services they're providing. But these are competitive and commoditized services that are being provided. So I don't know. Again, we don't need to get into the details, but I'm imagining that you're not paying much, if any, a premium for the services that either the chartered, bank partnership requires or the card servicing provides, right?
Yeah, that's right. It's pretty much commoditized across those. I mean, we felt like we negotiated really good deals. They have service level agreements in them.
Right.
The bank sponsor, call it Bank of Missouri, they do provide also a compliance function because they are
regulated
to regulators.
Yeah.
And we had our own compliance people, so we teamed up. We worked really well together. And they would provide they would do exams of our business, and the regulators would do exams of how they did our exams. So. There was a backdoor kind of regulation of our business, but again, credit cards is an incredibly regulated business. Card Act,
and becoming more so, by the way.
Becoming more so. Yeah, we talk about industry trends in a moment, but the Card Act redefined kind of how you did this business, and it is very kind of detailed in how you put together statements, how you treat customers, how you handle payments, all sorts of stuff. It is pretty prescriptive. And so it's pretty easy to live inside the compliance world because it's pretty explicit on what you can and cannot do. And anyway, at the end of the day, from a structure, I like to call it a plug and play strategy. Great management team, went out and got great partners, plugged them in. Nothing was developed from scratch. Plug and play allowed us to get to market really fast. From a zero, we were going 0 miles an hour in March of 2016 to issuing our first credit card by the end of 2016 is pretty extraordinary. And we did that flawlessly. And it's because, that plug and play approach, we didn't, I could talk about this as advice to entrepreneurs. There was no hubris on our part. We knew what we did well, what we couldn't do well, where the value was generated in the business. Operations adds a lot of value, but the real value of the business is generated out of marketing and credit. And, being able to plug and play some of these parts of the business allowed us to focus most of our talent in that marketing and credit analytics area.
Yep.
So from a funding, in addition to the equity, which is certainly, what we used to fund 2016 infrastructure build, we were able to go out and get a credit facility in 2017. We were quite fortunate to be able to convinced Citigroup, who is a top tier bank, to be the lead lender. A lot of folks in the fintech space have to go, I'm going to call them second tier, third tier lenders and investors, but those are places where people are paying a lot for funding. And for us, we were paying pretty competitive levels. Obviously priced for the risk that we represented in 2017, but able to put in place a $200 million initial credit line backed by the receivables that we were generating was key also. Citi was an amazing partner. Not surprising to me, I worked with Citi for a long, long time. They were always great partners. And, but that was we were able to get, an early part of the business funded from a debt perspective,
right?
Which was key. And then, we've just followed the model, which was, you continue to upsize that credit, that credit capacity over time until, and I think you mentioned it earlier, Will, a track record of your own data performance until you get enough of it where you can start to tap the term markets.
Right.
And so we did that through 2019, and we built our first master trust in 19, and we did our first term transaction in rather be lucky than good in early February of 2020.
Oh boy.
Late January, early Feb 2020, and right before COVID hit.
Yep.
And that first deal, $300 million, had Moody's on it, and which I thought we were very, very, very proud of to be able, because there are not many who are in our shoes who were able to get a top tier rating agency like Moody's, or an S&P. And we were very proud of that. And to us, it was a huge stamp, of kind of confidence in, what we were doing. And so, and I guess that's what we kind of came around and reconnected. But
yep.
But that was awesome.
But for all of the reasons that we talked about, so I'm not surprised. Obviously, I was there, but I mean, it was, confidence in management. Confidence in the asset class, confidence in the business model as it was defined and as it was demonstrated. Now, I do recall there not being a tremendous amount of track record, like data to draw from. Usually, ideally, you'd like to see something through the cycle. That wasn't going to happen. But you don't need to have something through the cycle necessarily. It's just especially in such a mature asset class as credit cards.
So,
right?
To my point before, this is not your father. This is just
right.
like your father's.
It is your father, yes.
If I can kind of show you how the asset that I'm generating looks exactly like the one that was generated early 2000s and went through the cycle, then, you have a little bit more confidence that, our asset's going to perform in a similar way.
This is pre-AI. Well, pre-AI, so you didn't have that. And it was also, I think, this was also before machine learning, because machine learning was the choice of was the vernacular before AI. I would say they're very similar, close cousins to one another.
Using machine learning models,
right? Which is a fancy word for saying we iterate. I think, but this was what I'm trying to say is that this was arguably in a different era now relative to today.
Yes.
Yeah.
We could come back around to
the
fintech and AI and all that. So the underlying, so where's credit card going in those kinds of things? The underlying investment thesis for FairSquare was, as I mentioned before, it is ultimately overwhelmingly the best consumer asset class. And the thesis that Pinebrook uses is, and Vikram, is that ultimately if we could somehow build a new credit card business around this product,
Mm-hmm.
it would ultimately be very lucrative, especially given how enormous, and you use the word ubiquitous, the ubiquity of the product
Mm-hmm.
that produces a superior risk-adjusted return through the cycle. I mean, it is just demonstrated, and therefore, that if we could do it, it's going to be an inherently valuable asset in terms of the business. And in fact, COVID was another proof point, right? I mean, you couldn't leave your house. You had to buy groceries. You can get them delivered on your porch. You had to use a credit card.
Right.
It's just another proof point of how valuable the product is. But and so for all of those reasons, a credit card business, everybody wants one.
Yeah.
Everybody wants one. But
And increasingly, you almost need one. And I would even point to the great financial crisis as another example where, people were unemployment rates again were very, very high, like they were initially in COVID. People were concerned. You heard people, certainly without equity in their houses, leaving the keys, under the mat and walking out of their homes. But they weren't doing that with their credit cards. They were hanging on to those for dear life because they allowed you to put gas in the gas tank, groceries on the table, so you could get to work and continue to earn income. I mean, that they definitely proved to be one of the most valuable assets consumers had during that very difficult time as well. So there's the most recent crises, and they were big ones, both of them, and they were very different from one another.
Yes.
And credit cards as a product came shining through, I think.
Yes, absolutely. Yeah. So, everybody wants one, but they're incredibly hard to build.
Right.
And so I think the FairSquare story is really one of where stars aligned.
Mm-hmm.
There are a lot of guys, lot of companies out there, whether new or existing, have tried to build card businesses and they've not been able to do it. And I think the FairSquare story is a unique one where stars align. We've talked about them, what those stars are: a great management team, backed by solid equity,
Mm-hmm.
and kind of taking a risk-adverse approach to kind of aspects of the business. The plug and play of like the of tried and true partners to build that business. And so it's a rare event.
It is a rare event, and you succeeded. Maybe we should talk a little bit about then why ultimately it succeeded in a way that many people would like to see it succeed. You sold it for, I presume, good money, good profit. But so maybe we go into that part of the story here, because you had, again, another very kind of linear upward ascending path. Asset growth, success in underwriting, access to the capital markets. And then the pandemic hit, and maybe that's part of the story here, and you sold.
Yeah. Again, we believe starting out, along with our equity investors, that ultimately somebody's going to want this thing and pay for it, and and all we have to do is execute. So that line of equity was key because it allowed us to just focus on execution. We executed flawlessly. We knew that people would come a knocking. People did come a knocking. I don't know, let's call it 2019 or so. It was too early to sell it, and then early 21, others came a knocking, and we had great internal debates. Is this the right time? We were fast approaching break even. So in the card business, we have the so-called J curve, which means that you spend all the marketing up front to build accounts and receivables that produce annuities that are in the future.
Right.
You build the loss reserves up front. So you build that, you dig a big hole. That's where the equity came from. But we were reaching the point in 2021 where we're going to reach that inflection point where the cash flow from the back book that we had built with all that investment was now going to produce more than
cash flow positive.
We'd be becoming cash flow positive and profitable
Okay.
into 2021. So should we sell?
Right.
As people came a knocking, and we ultimately decided that it would be great. I mean, we had somebody kind of with the reputation of Ally, which we thought fit perfectly with kind of the core segments that we were going after.
Mm-hmm.
In their auto book, they're big auto, obviously one of the biggest, if not one of the biggest auto lenders out there, and really good brand.
They have a bank.
They have a bank with a huge deposit base.
Mm-hmm.
We used to have, a Capital One, whether it's being an asset business there's a whole bunch of these deposit-only fintechs. We used to call that one hand clapping. You have a lot of deposits, but you have no assets. You have a lot of assets, no deposits, and you really need both,
right?
To really be successful.
That's good.
And sustain and have a sustainable, profitable business over time. We really thought some of these deposit-only fintechs would come a knocking, but they really didn't. I don't know why, because they're going to figure it out someday that they need another hand to clap with their hand. But Ally had both, right? They had brand, deep, huge pool of deposits, lower cost funding, resilient.
Consumer touch points with probably an opportunity to cross sell there. I'm imagining huge, right?
Absolutely. So we thought, hey, this made a lot of sense, and we got it done by the end of 21. And I think again, I'd rather be lucky than good. Early 22, Fed starts raising rates, valuations go
down.
You know where they went, and but so we, from a seller perspective, I felt good. Listen, all my colleagues are still there running the Ally car business. I root for them every day, and they're doing really, really well. But as I think about it, I'm really feeling quite lucky we did it at that time. But despite all of that, Ally got a really great business that will serve. You have all of this kind of thing that has happened in 22 and 23, but that's a long-term strategic investment for them.
Yeah, I was going to say this. When you look back at that period that you just mentioned, the last several years in the rearview mirror, with enough time, this is going to be again just a small divot in what you just zoom out just a little bit, and you can see this long-term secular rise in receivables growth that continues, at pace.
Yep.
And as you said, this is I've been doing this long enough where I've heard, too many times people spelling out the demise of the credit card product. It is just unbeatable. And no one has come out with a better mousetrap over now. What is it? 40 plus years, maybe longer. Exactly. So yeah, I have a lot of confidence in the business model for anyone who can run it. Who can run it responsibly.
Yeah, so they got a rare and valuable asset, and I think it was a really smart move on their part.
Yeah,
there are some smaller independent, I'll call independent players out there. A lot of them are kind of on the subprime side. Will not be as valuable because of their subprimeness. That's why we wanted to play where we played in kind of near prime and stay close to that 660 score. There are some other smaller players that are niche, going after a really niche market, but having been around this business for so long, those businesses, I don't see how they're going to get the scale necessary to have a meaningfully profitable business. I mean, you have to be a million in customer accounts. You need to be $1 billion in receivables before you're going to be able to have a meaningfully profitable business, and that's not easy to do. So the industry continues to be consolidating. Obviously, I think you kind of waived that new regulation that imagine you're thinking about the late fee. Listen, the industry has dealt with these kinds of things throughout its history and finds ways to create it to maintain a really profitable business.
This is the late fee. Now the CFPB has basically, I mean, not quite, but basically mandated a late fee of no higher than $8.
Yeah.
Whereas I think the industry average was in the mid 30s.
Yeah.
Or $32 or something like that.
The original rule on that was put together with quite deliberative analysis back, and this is associated, I think, with the Card Act, where the Fed said, the number should be about 25, and adjusted for inflation.
Right, exactly.
That was a safe harbor, and I was part of those conversations. It was analytical, thoughtful approach, and this. Listen, I don't want to go too sideways on regulation, but the issue is, and what regulators don't understand sometimes, is that regulation like this only results in more consolidation and less competition, because the less profitable players, and by the way, there's higher capital requirements coming out, right?
And I think you're leaving out less credit availability to the very people that they are trying to, help or give.
Yes. So it's going to lead to more consolidation.
Right.
Less competition.
I mean, I'm not even. Look, from 32 to 8 is a lot. The credit card companies, as you know, have a lot of dials they can turn to make up that loss in revenue. It will, on the margin, probably hurt, at least in the short term, before credit card companies figure it out. But they're going to figure it out doing things like, I'm not going to underwrite to as risky a borrower anymore, because I'm not going to be able to make up for the time value of money that I'm losing by not charging the appropriate amount of late fee. Exactly. So, or I'm not going to give as lucrative rewards points to my cardholder base, because those are coming out of, at least in part, those are being funded by ancillary fees like interchange and to some degree late fees as well. It's all kind of a pile of cash. But, I think the flip side of that, to give the regulatory perspective some voice here, is that, the credit card companies are, as we've pointed out, it's a great business model. They're making a lot of money, and that is late fees in particular are being charged to the very people who are the most credit needy. They're not all just lazy, sloppy payers. They're people who are up against true hardship. And so there is that, I'll call it a social/political dynamic to it that they're trying to address, that I think is, it's fair and part of their mandate to some degree.
True. And but at the same time, those kinds of things exist throughout.
They do.
Many different industries, right?
They do.
And it's
insurance, another one.
It's pervasive everywhere.
So the late fee is an interesting one, but I think, you mentioned consolidation already happening. We don't have to look any farther than Capital One. I mentioned that at the top.
You mentioned interchange,
and interchange as well, also being, that's getting, challenged, across several different angles. We have even preemption, national charter preemption, being challenged in a case that I'm watching. I think it's, if I have the name right, Canberra versus B of A, if I'm not mistaken. I'll have to look that one up. But there's that one. There's the Chevron case, of course, which is very broad, but certainly comes back to several decisions that affect consumer credit broadly, but credit cards even more specifically. We have the don't forget about the CFPB versus the National Collegiate Student Loan Trust, which sounds narrow to the student loan sector, but actually it has implications for securitization in any consumer credit sector, because it challenges the notion of bankruptcy remote trusts. Essentially, the trust can be found liable for the actions of their third-party contracted servicers, for example. Yeah, I don't know what you think about it. I mean, so the landscape is, I mean, look, I think I'd love to hear what you think about this, because challenges are not new. I don't think it feels kind of like that maybe there's a bit of a crescendo going on here right now in this moment in time, but you've already spelled out a number of incidents in your career trajectory where there's an ebb and flow to the degree and amount of regulatory oversight and, call it, interaction.
Yeah. Just to be frank, I'm not that up to speed on all those examples that you gave, but I mean, I remember back, I forget what year it was. It might have been 2009, 2010, where card securitization, was no longer off balance sheet. It wasn't regulated. It was the accountants. And like we thought the world was ending. And all we did was, all right, we got to hold more capital because all those assets are coming back on balance sheet. Okay, that's the cost of doing business. Fortunately, we have a great one, and we can still generate really great returns on that capital. But
FAS 140 maybe? Was that?
Yeah, but I thought the world was ending.
Yeah, I remember that. Yeah.
So I don't know. They have to proceed carefully because ultimately, as you point out, the consumer is at the end of that chain, and if you can't securitize, the liquidity is gone for these lending businesses. So I'm not exactly sure how a consumer, if the consumer is kind of at the tip of the spear of those cases because they felt wronged. Broadly, consumers can get hurt. Like if there's no liquidity that comes from securitization,
right,
that's going to be an issue.
So, Steve, I think we've covered a lot. I think we've gotten to the sale of FairSquare now. I feel like this is the right time to ask you kind of a capstone question, given your experience, and I guess we ended on your entrepreneurial experience, but
right.
What kind of advice can you give to folks who are either just starting out or even midway through their careers in finance? I mean, you've given some advice along the way here, but maybe you can kind of tie that up in a bow here. I think that would be really instructive and valuable.
Yeah. First, I think foremost, you got to really reflect and examine what's your purpose in doing and kind of entering that realm, and work. You got to. It's not unlike what I described in outlining how I thought about my career. Is really kind of sit down and write down on a piece of paper what exactly are you working back from, and in entering in that realm, having a clear view of that is critical. But I think it's also critical that you do a lot of due diligence on those people that you're going to be working with and for, to making sure that you're working with really high quality people. And that you have the open, direct conversations about what everybody's interests are, and making sure that when everybody articulates those interests, there's an alignment there. So everybody's really sure about why we're doing this and what we're working back from. I think is really essential. But I can't stress enough, like, the quality of the people that you're going to work with is number one. We talked about trust before, and kind of in the financing realm. You've got to be able to trust these people that you're going to be working with, and because, like in any kind of entrepreneurial context, it's not all going to go smooth.
Right.
We were fortunate at FairSquare; things went pretty smooth along for most of that time. We were quite fortunate of starting that business in kind of zero interest rate environment, historically
Right.
low
You had some runway.
That was easy, but it's not always going to work that way.
Right.
And making sure there's trust among all the people that you're going to be working with. I can't stress all these things. These are soft things. It's tangible. Everybody gets caught up in the greatest, coming up with the greatest idea and innovation, all those things. But fundamentally, it's running organizations is about people and having a clear, compelling, bold vision of what you're working back from, and getting alignment is how you get it done. And so it's got to spend a lot of time on that.
So I hear what you're saying. I also have heard throughout my career people, friends, colleagues who feel that they're in a toxic professional environment with respect to that trust quotient that you just spoke about, or I think that's a good way of putting it. The advice there would be look elsewhere.
Life is too short.
Yeah,
life is too short.
Right.
There's so many great opportunities out there. You got to make a lot for yourself. Again, that's why I come back to for your career, figuring out what you want to do. Write it down. That's what I always tell young people that come in for career advice. Go write it down and come back to me in 5 days and show me what you wrote. Because it really forces you to think about what it is and be clear about it. It's life's too short. You got to move on. I mean, I've been so fortunate in every place I've been, but I did my diligence.
Right.
Going in.
Right.
And, it's interesting when I thought about this. Listen, I was approached for jobs when I was CFO at FairSquare, but and I always like to talk to people. Like if I have an opportunity to talk to a CEO who wants to interview me, I may not be interested all that much, but if I can talk to a CEO about what they do, I'm doing it. I'm taking that call.
Right.
That's just another learning opportunity. I'm talking to every CEO that I could possibly talk to. And I kind of learned if I'm not being asked really hard questions, I don't want any part of that organization. You try to get into Capital, and when I was trying to be recruited at Capital One, I was tested, business cased, tough behavioral interviews. It was kind of reflective of the level of talent that existed there. And if you're just being asked, what'd you do on your last job, blah, 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 what do you like? And that's not where you want to go. Right. You're not getting challenged on really hard questions. Don't have anything to do with it.
I think that's really valuable. I agree with you. And I'm also, as I hear you say those words, and many companies out there are known for having rough interview processes, or used to be. And so I'm wondering out loud if that dynamic has changed over the years, where for one reason or another, it could be legal for all I know.
Compromised because it was really hard to get people.
Yeah. Oh, that too. Yeah. Right. Yeah. I mean, so, I just wonder if that dynamic has changed a little bit, and for the worse, probably, because neither the employer or the candidate get as much out of that interaction as they ought to, because it is, you want both people to be happy, both sides to be happy.
Yeah. Yeah. I think some more kind of words of wisdom. I think humility is really, really important. It goes a long way. There's so much hubris out there, in startups where you have really smart people who are trying to start a business. You're going to make mistakes. You have to be honest and unemotional in diagnosing why those mistakes were made. Those lead to great learnings. You have to have an environment that's really safe to enable all of that to happen. And so if you're a leader in one of these situations, that's your job, is to be really good at that and fostering an environment that's really open, that allows people to make mistakes, but we're going to learn from it. And, again, Capital One was amazing at that. I mean, the credit analytics kind of school has, spent a lot of time diagnosing and going over where mistakes were made.
Mm-hmm.
That's where all learnings were done. And those that we talked about, war stories, the case studies are the most interesting things to us. So we listen to a podcast or read a book. That's what that is, and it sticks with you. So those are great opportunities.
I would say that what my observation again in this realm is often people confuse hubris with confidence, and they want to project confidence, and they think therefore they need to know everything. And I think you're saying it accurately. I can't really articulate it better than you just did. Is that no one is making 100% correct decisions all along. So you need to be able to own when things go wrong. You need to, and more than that, as a leader, as you're describing, you need to create an environment where there is the allowance for mistakes.
Yeah.
Because that was something certainly that we tried to do at Moody's as well, was to create an environment. You did not want people to be shy about sharing a mistake that they made. That can lead to really awful things, right?
Yes,
People
exactly.
try to smother or hide errors or mistakes, or have a fear of doing. I mean, that's a really bad culture. I've been in those in my deep dark past as well.
Yeah,
and that's
you got to set some sort of kind of boundaries where people can operate, but within those, they should be free to do their thing, and they're going to make mistakes in there. But if you set the boundaries in the right place, you're not going to blow up the place,
right?
And a lot of great learnings will come out of that. So fostering that kind of environment, is great. So I think having a bold and compelling vision, getting alignment, these are all competencies of good leadership, and kind of one can use in trying to take people to a great place. They have to be able to see in that vision what's in it for the consumers or the customers that we're going to service, because that really helps, as well as what's in it for the associate. On the former point, and I'll kind of end on this note. When I joined Capital One in '97, we kind of all understood, and we talked about this all the time, that we were on a quest to change the world in terms of bringing credit access to people who had never had credit before. I mean, we're on a quest to do that. And we deeply believed in that mission. And some years later, I was on a non-deal roadshow, talking to investors. I was out in Chicago, and I was with a couple of my investor relations folks that helped me in these things. And we were in the back of we were going from one meeting to another. We were in the back of a black, town car.
Right.
And we were all chatting about how that went, what we were going to do in the next one, blah, blah, blah. And the driver, who was a woman, heard us talk. She figured it out. We were from Capital One. And at a stoplight, she turns around and says, you guys are from Capital One, right? I said, yeah. She goes, you know what? I newly became a single mom, and I needed a job. I needed to get a new job, and I got this job at this limo company. But I needed a car to get to the garage where all the limos are. And she goes, you guys were the only ones that would give me an auto loan so I could get a car to go to work to be able to support my child. And I said, that's why I came here.
Right.
That's what that was all about. And if you're focused on creating something that is aimed at that kind of thing, you're going to do well. That's a great
anecdote. It's kind of like, I don't know, the equivalent would, I guess, if you were in a creative space and you wrote a song, you heard it on the radio, right?
Yeah.
I mean, it's just you're helping someone's life.
Yeah, and that's really what we should be all about. And I knew then and there that ignoring my dad's advice and going to Capital One was the right thing to do.
Yeah.
It just felt great.
Well, Steve, that great anecdote to end on. We've had a long conversation. I knew that we would have a long conversation. I think we both knew that it was going to be long for good reason. There's so much material, and I'm sure we could have gone longer, but I just think we covered so much great material. I really, really deeply appreciate your time and just so much experience and wisdom to share, and getting that out there to the world of finance and consumer credit, I think is really very valuable. And I certainly appreciate the time that you've taken to share your story with us. So thank you very much.
Very welcome, Will. It was it was an honor that you asked me. And it was a real pleasure kind of thinking to be able to do it. It forced me to kind of go back and think about the long, strange trip. And so it's been really, really satisfying in a lot of ways. So again, thank you so much for spending the time with me.
Thanks. And thanks, everyone. Take care.